Stanley has recently raised China's recommendation rating in response to the news that China had further loosened some of its COVID restrictions. China was moved up to an overweight position from equal weight, which it had been in since January 2021. Now, after almost 2 years, Morgan Stanley is once again optimistic on Chinese stocks, but it has remained underweight on India. Let's understand why. Indian stocks have performed better than those of emerging markets. Now, both Sensex and Nifty have risen to record high levels as a result of sustained domestic flows and return by FIIs. Now, we can see that Indian markets have done well despite the chaos around the world and the challenges of rates, inflation, and recession fears. However, Morgan Stanley believes that other emerging economies may now be more appealing from a valuation standpoint than India as a result of the dramatic outperformance. Do understand that underweight or overweight positions are typically more on the back of valuation, and it doesn't indicate how appealing or attractive a stock, industry, or country is. Now, this is a short-term view of Morgan Stanley on its fund, as India has outperformed while valuation of some economies like China are at historically low levels. Now, on a long term, however, Morgan Stanley does believe India can continue its outperformance. Also, India's economy is less reliant on exports than the majority of Southeast Asian countries. While global events will naturally impact India through weaker export demand, the Indian economy continues to be domestic driven, with consumption and investments contributing to 70% of the economic activity in the country. The ratio of corporate profits to GDP, which reached a decade high in Q2 fiscal year 22, has drastically decreased over the last 2 quarters, reversing the rapid climb. The aggregate net profit of 3,361 listed companies was around 3.48% of India's GDP at current prices in the second quarter of fiscal year 23, down from 3.57% in the first quarter and 4.39% in the second quarter of fiscal year 22. Now, the decline in corporate profits to GDP was due to a decline in overall corporate profits and also a rise in overall nominal GDP on the back of inflation. Now, when we talk about the decline in corporate profits, this was largely due to the contraction in earnings of manufacturing companies due to the impact of higher input costs and low price realizations in many segments. Now, this was also seen in the Q2 GDP data, where the manufacturing GVA declined 4.3%. However, due to the festive season and the decline in commodity prices, we can anticipate the sector to do well in the upcoming quarters. On the other hand, banks, financial services, and insurance companies reported record high earnings in Q2 and have also increased their profit share. So, what does these news mean for you? The underweight rating on India reflects Morgan Stanley's short-term outlook for its fund, as the country has outperformed other nations like China, whose valuation is at historically low levels. This will have an indirect neutral impact on you. Despite several headwinds, corporate earnings for Q2 were better than expected, with financial services and the banking sector driving the quarter. The improvement in corporate profit to GDP could reverse on the back of easing commodity prices. However, the current adverse macroeconomic backdrop could pose a challenge. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.